Actually, you can share the screen if need be. You ready?
Excellent. Thank you very much. Yes, I am ready.
Oh, you got some good audio. What you got on? That sounds good. Your audio.
Thank you so much. I do quite a few podcasts, so had to upgrade, and fortunately it's not that expensive, so able to not break the bank on that. Are you able to see my screen?
It's coming up.
Okay, excellent. Let me know when you can see it. It's quite a lengthy presentation, so I want to make sure that everyone
Got
can
you.
see
We
it.
see it. Everybody see it? Everybody thumbs up?
Yep.
Yep.
Thumbs up.
Good deal.
Excellent. So good evening, everyone. My name is Ashley Wilson. I didn't get the memo on the whiskey, so hopefully this presentation is very coherent. And, I just wanted to start off by saying thank you so much for the opportunity to present our current property that we have under contract, the Augusta Court, located in the Galleria area, which is in uptown of Houston, Texas. It's 150 units. It's a Class B property located in a Class A location, and it's 1982 construction. Before I get started, obviously, I have to highlight the disclaimer because, of course, my wonderful lawyers from Premier Law Group have instructed me to do so, but I want to make sure that all of the information remains confidential and unauthorized use of this information is prohibited. Please make sure not to distribute this information. If you are not the intended recipient, please notify us immediately, and make sure to know that this is not a general solicitation of any kind. The information contained herein is from sources believed to be reliable. However, no representation by myself, the sponsors, expressed or otherwise, is made as to the accuracy of the information on the property, and all investors should conduct their own research. The SEC has not passed any merits of given approval to securities or terms of this offering, and making any decision of any time, you should review and execute the private placement memorandum and all related documents before taking action. Make sure that you know that any forward-looking statements for terminology that I will be using, such as may, will, seek, should, expect, anticipate, project, estimate, intend, continue, or believe, or negatives thereof, are comparable terminology, and they are only made as of the date of this executive summary, and sponsors undertake no obligation to publicly update such forward-looking statements to reflect subsequent events or circumstances. The business plan I'm about to show you contains financial information, projections, and forecasts, and these are estimations. They are not, numbers are obviously subject to change as we get further information. These are assumptions and hypotheses. Please make sure to do your own due diligence and your research, and consult your lawyer's CPA in pursuing of this investment if this is of interest to you before obviously taking any action. So in conclusion, the sponsor, myself, makes no further representations or warranties that any investor will or is likely to achieve profits similar to those shown in the performance or other financial projections. So now that I have that stated, and we can continue. Very high level here. I mentioned before that the property is located in the Galleria, the Houston market. It's a mid-rise 150 unit property in a B+ property in an A- location constructed in 1982. We are purchasing the property at $19.6 million. With respect to the opportunity, it has very strong market fundamentals, being an A-class area. It is 2 minutes from the Galleria Mall, which is a very uptown exclusive mall, and it's 2 miles from George Bush Sr.'s house, fun fact, and 20 minutes from the medical center and the new Amazon fulfillment center that that is being built in Houston. We have a projection rental bump increase of $360 per unit. And also another opportunity here is we have 3 exit strategies. I will go into that a bit further, but 1 is the standard typical value add strategy, 2 is sell to a developer, and 3 is sell as condos because their units are already separately deeded, and I'll get into that a bit further. In terms of the investment opportunity, the equity capital needed for this property is 8.3 million and change. Our projected returns are an 8.26 average annual return, a 16 IRR, 9.34 average cash on cash, 1.91 multiplier, and that is under the assumption of a 5-year hold.
Hold.
No, it's good.
Yeah, the lovely things of technology. I think she got disconnected.
Do y'all hear anything?
No.
Yeah. Yeah.
Is she's gone?
Yeah, she's gone. I think she got disconnected.
Pop back in.
It's so funny to see you on 2 screens, Kaylee. It's hilarious. Oh, and now there's me.
Oh
Look.
God.
Look, and now there's you. Now there's me. And wait, you talk again. You talk again. Your turn. Ready? Talk.
Better wither
Oh,
it
there's
out.
me.
We're on Terry's screen. Someone's drinking. Cheers. I've got a CBD drink today.
Oh, hey, it's all good. Whatever floats your boat.
I've got to go have dinner with an investor, so I'm like, this is not. It's different. It's different. All right, so 130K a door.
Hey, Kaylee.
Yo.
Since there's a lot, well, there's not a lot. Well, there's a lot of women on here. Tell me about Crew. I've never heard of it.
Yeah, Commercial Real Estate Women. It's a global organization, and basically there's chapters in different places. Like
Okay, here she goes. She's back.
Oh, she's back. Okay, cool. Just look
You
online.
can email me anytime.
All right, cool.
I'm sorry about that. I'm not really sure what happened, but
Technology.
fortunately I have enough. Can you hear me?
We can hear you fine.
Yeah.
Okay. I apologize for that. I'm going to continue sharing. If you wouldn't mind just letting me know where I ended. Oh, sorry.
The
Hit the
3
wrong
exit
button.
strategies, you said you'd go back to that later, I think.
Okay, excellent. Sorry about that. The beauty of technology, right?
Nope, sorry, it's your computer's fault. Damn computer.
A couple weeks ago, I was on a presentation and I was a co-host, and it
Right here.
shut off. It shut off in the middle with over 250 people on, so that wasn't good. That wasn't my computer though. That was someone else's. Okay, so we went through here. Can you see my screen? Can everyone see my screen?
Yeah.
Okay, excellent. So I'm just gonna skip through this part here. Okay, so moving forward. Today, what we're going to cover is we're going to cover our team. We're going to cover why we selected Houston, why we selected our property that we did, the business plan, the timeline, and next steps and Q&A. Starting with our team has a combined experience of over 70 years of real estate experience. We have combined experience of over $500 million in transactions. We've invested in over 15 states across the country. So we have quite a experienced group to execute this deal. Starting with myself, Just to introduce myself a little bit further, I'm a key principal. I handle asset and construction management, and I lead asset and construction management on several other projects right now. And I've led over $5 million in construction. And in terms of asset management, I've led over 30 million in terms of asset management on previous properties that we've done. The next member of our team is Mr. Bob Ryanton. He is also a key principal. Fun fact about him is he has over 7,000 historically and currently a combined over 7,000 units, and he currently has over 700 doors under contract as we speak. This handsome fellow, and I can say that because he's my husband, he handles all of our underwriting. He's underwritten over 200 properties. Fun fact about him is prior to us, well, the whole reason we got into real estate, in all honesty, is because he used to be a professional ice hockey player, and he played professionally for 11 years and has dived headfirst into real estate. He handles all of our underwriting because he's a very analytical person. He was actually supposed to go into chemical engineering, but then got drafted to play in the NHL. The next gentleman we have is Mark Rios. Mark Rios is a financial advisor. He's also a general partner, and he serves and manages all of our configuration with securing the debt and acts as a financial advisor across the entire project. Jay Scott. Jay is, maybe you've heard of Jay Scott before. He is a best-selling author. He's written 4 books, 2 of which are on the top 10 best-selling real estate books of all time. And he serves as a general partner executing the due diligence aspect. And along with Jay, Cal Crowden also serves as another general partner helping with us during the acquisition process. Next, we have Anna Kelly. Anna Kelly is a general partner, and she handles investor relations. And we also have Jeff Greenberg, who also is a general partner in investor relations. Anna Kelly has over 2,000 doors, and Jeff Greenberg also has over 1,000 doors. Anna Kelly is a best-selling author, and Jeff Greenberg is very well known in the student housing community. He is actually the first person who really came up with the idea of taking the value add strategy and deploying it in the student housing sector. This is a snapshot of just some of the real estate holdings that we have or currently hold. So as you can see, they span all different states, all different asset classes, and it's quite a lengthy list, to be honest. Next, we're going to cover our property management company that we are using. MLDC Management is located out of Houston, Texas. They have 1,590 units currently under management. They are a boutique type property management company who turns away between 3 to 5 offers a week to run their properties. They are very specialized and go above and beyond in executing your business plan. This will be the 3rd property that I work on with both Courtney and Lori. And they are beyond exceptional and very well connected in the industry. So it's very favorable to work with them for a whole host of reasons. In terms of what sets us apart, let's start off with a community. It's our goal that every property we purchase becomes the beacon of the community. We're able to achieve this by partnering with local companies, charities, and organizations, and we create win-win situations because ultimately we believe when the community wins, we win. Next, with respect to operations, we believe the property's operations are the most important aspect of apartment ownership. We think a lot of people overlook this and are solely focused on acquisitions and also capital raise, but I have made it my sole purpose to figure out every granular level detail of operating a property. So another component of that expands over to our property management team. We treat our property management team as a partner, as opposed to a service provider, and we have seen incredible wins because of this mindset, along with the actual execution of our business plan. Last but not least is our partnership. Along with monthly and quarterly updates, we provide access to all of the property's financials and reports. We also list direct contact phone numbers. In fact, my personal cell phone number is at the end of this presentation. If you have questions at any time, you can call me directly or email me. It's our goal to provide a high level of transparency to not only build trust, but we want to create a foundation for a long-lasting partnership as opposed to a just one-off situation. So let's start first with why Houston. So Sharks, what city is Houston about to surpass in population as the third largest in the US? Anyone?
LA.
Any other options?
New York, Chicago.
Chicago. So Houston is about to surpass as the third largest city in the US. A lot of people don't even realize that. Houston has a lot of incredible accolades, and we can see that on 3 different categories. First being a city in which it's great to live in. So if you look at all of these different accolades, we can see that they're #1 on America's 50 best cities to live, #1 top US destination cities, #1 nation's best cities for millennials, #1 most diverse cities, #1 top metro for young adults, #1 best race and class interaction, #1 in best US cities for expats, and #1 in best hospitals in America. If I was to list all of the #2s, it would take up another slide just this large. So Houston has a lot of excellent reasons in which people want to live there. U-Haul, the top US destination cities in 2008, U-Haul puts out, I'm sure some of you may already know, but U-Haul has incredible data on where people are going, because obviously if you're moving somewhere, you most likely will be renting a U-Haul. So to have an accolade from U-Haul is a pretty big deal in terms of different accolades to possess. Next, if we look on the work front of Houston, Houston has the highest average starting salaries, the highest annual median wages for STEM workers, top metro for construction growth, #1 in commercial real estate development, #1 in job creation by foreign direct investments, #1 in growth prospects, #1 for state for businesses, 14 consecutive years, #1 in best state for women entrepreneurs, and #1 in most competitive cities in total energy. Speaking of energy, and I want to see what all of you Sharks think. What percentage does the oil and gas industry make up of the entire Houston economy?
2 to 5%. I have no idea.
25.
Anyone else?
10?
Shockingly, Houston actually only makes up oil and gas in Houston only makes up 2.7% of their entire economy. Houston has historically been known as an oil and gas city, but it is not an oil and gas city anymore. Houston has spent a ton of time diversifying their economy, and when you look at oil and gas and fringe industries, you get to 7.4%. So supportive industries to the oil and gas total with oil and gas, 7.4%. So historically, I know there has been this perception that Houston is strictly an oil and gas city. That is not the case anymore, and the data supports it. Houston has spent a lot of time diversifying their economy. They have appointed a whole section of their government to speak to recession-resistant planning and resiliency. And one of the things that they do in there is attract different industries to come to their market. If you look at top industries in the economic sector, it starts off with trade, transportation, and utilities, professional business services, and then we are looking at government, education and health services, leisure and hospitality, manufacturing. Oil and gas and fringe industries only comprise, in terms of ranking, at the #8 ranking in all of Houston's different employment sectors. it is actually being surpassed currently by the technology industry, which is serving at number 9. So the technology industry will shortly surpass and take over as number 8 with the construction of the Ion in downtown Houston. Houston wants to be known as one of the top tech centers for people to come to, and it has already achieved that in the medical center. By the medical center, which is only located 20 minutes from our property, it's actually a little bit less than that, is comprised of an entire zip code. 106,000 employees work at the medical center, and over 160,000 people visit that medical center a day. So it is quite a diverse economy. When we look at why you should invest in Houston, it's the #1 nation's top buy markets for multifamily, as 10X reported in 2019. It's the top metro for most capital investment projects. It was #1 best state to start a business, #1 best state for landlords. It was a top US metro area population growth, top manufacturing US GDP, and it was #1 top metro for economic growth potential. Now let's drill down a little bit further to the Houston submarket. So this is specifically where our property is located in the Galleria and Uptown area. 14 largest office space in the US, 2,000 companies, 12% total Class A space, 200,000 residents, and 30 million annual visitors a year. This picture that you're looking at is the Galleria. This is a mall that is located less than a mile from our property. And the Galleria, it is owned by the Simon Mall Corporation. The Simon Mall Corporation puts out studies not too frequently, unfortunately, but their last study they published was in 2013. In 2013, they found that there is a huge pool for Chinese tourism to this area. And Chinese tourists tend to stay on average of 2 weeks when visiting the Galleria area, and they spend on average $5,000 per person. So that was back in 2013. It probably is a bit higher than that today. If you look at in terms of where our property is situated on a map, you can see that it's right outside the inner loop, and it's in the Uptown area. Now I have a short video on the neighborhood. Oops, let me just open this up. So here you can see Houston, and you can see how close the property is located, not only to the Galleria, but the medical center, and George Bush Senior's house is located just 2 miles from the property as well. And then we'll take a little bit closer look at our property. So, okay. Now what we're going to do is we're going to drill down a little bit further on our specific neighborhood. This neighborhood comprises a 2-mile radius, meaning that if you were to drive around this red rectangle, it would be a little bit under 2 miles. In this area, pre-COVID unemployment rate was 3.3%, where the US average was 3.6%. This area is comprised of 77% of college degree residents, and the US average is 30.9. So you can see this is a highly educated area. And when you dive down into the professions, 69.1% are executives, managers, and professionals, 20% are in scientific and technical services, and then you can see the additional fields. All of this data was taken from Neighborhood Scout and pulled on July 11th, so this is recent data, and it continues on to the next page here with medium home values at $282,000. Per capita income is $66,885, where the US average is only $31,177. Medium household income is $86,133. 61.3% of the people in this area are renters, and 63.1% are one-person households. What's interesting about this area, and I'm going to go back to this fact in a little bit, so just remember these 2 facts I'm about to tell you. Over the past 5 years, if you look at a blended average in this particular market, there was a 3.4% average annual rent increase year over year, if you look at the blended average for the past 5 years. The US average was only 2.9. If you look at the average market rent in this area, it is $1,782. So just remember those two facts, and I will get back to those shortly. Notable and unique in this area, as I mentioned, 63.1% of people are living alone in this area, which is higher than 99.5% of all US neighborhoods. I spoke about the level of education. 77% have bachelor degrees, which is higher than 97.8% of all US neighborhoods. And when we look at professions, 69.1% are executive managers or professionals, which is higher than 97.1% of US neighborhoods. And with respect to our apartment buildings in this area, there are a lot of apartment buildings. 71.5% of buildings here are apartment buildings, which is higher than 95.9% of all US neighborhoods. Now let's drill down onto the actual property and look at the property details. As a reminder, we are purchasing it at $19.6 million, which is $130,000 and change per door. Interestingly enough, we had this property under contract prior to COVID at $22 million, and we negotiated 11% discount. Previously, under COVID, at that 22 million marker, we also were purchasing at a 5.75 cap, and I will get to that in a second. The property was built in 1982, 150 units. They were separately deeded, and the reason they were separately deeded as this property used to be a condominium. In fact, there are 152 units on the property, 2 of which are still individually owned, and 150 units were converted back into an apartment, but they remain separately deeded. It's a B-class property in an A- location. Our plan is a 5-year hold, and now I will dive a little bit further into the 3 exit strategies. The first being a traditional route, the value add strategy, which I think we're all familiar with. 2 is a condo sale, meaning we would convert these back to condos. They are already separately deeded. It is very easy to do in the Houston market because Houston has no zoning, so it's very easy to convert things back and forth. And 3rd is a land sale. This area is predominantly new construction. In fact, this is the only remaining 1980s large apartment building in this area. Everything else has been torn down and rebuilt. So every single comp in the immediate area is A class, which obviously we will never be A class. And we've put in safeguards in place to differentiate our product from the rest of the market. Current statistics on the property, it's 92% occupancy. Per Yardi, the historical annual average occupancy is 97.9. We see a drop in occupancy for 2 reasons. 1, obviously COVID, we've seen that across all of our portfolios, but 2 is also because this owner is selling and is not motivated to keep the occupancy high. We've seen a decline. We've put safeguards in place in our purchase and sale agreement to combat that from continuing that downward trend. So they need to fulfill the requirement of 92% occupancy. All applicants need to still fulfill original requirements that were required prior to the property being on the market, as well as the concessions. They cannot offer steep concessions. We have a limit on the concessions as well. So we put safeguards in place to minimize our exposure upon takeover that we inherit horrible tenants. With respect to average rent, $1,306 is our current average rent on the property, and that is post or during COVID, mid-COVID, I would say. Per Neighborhood Scout, as I mentioned before, the one thing I wanted you to remember is the average market rent is $1,782. So you can see a huge differential between our property and the average market rent in the area. In terms of tenants' income, this is a bit of an anomaly, especially when we are pushing rents $360 a door. Our current tenant base qualifies on average for our new rents. We have underwritten the property for a year 5 average rent at $1,789 a door. The current tenant base can support $1,809 a door, and that's a 3x rent to income requirements. So that is a bit of an anomaly. I know on smaller yields, you can find properties like this, but typically when you get into several $100 rent bumps, you do not see this as an opportunity. And last but not least, With respect to calling Augusta Court a home, 93 tenants out of 150 units have been at the property for 2 years or more. With respect to current amenities, there's a leasing office, a pool deck, pool and sun deck, a gym and sauna, washer and dryer, fireplace, and they offer free house cleaning right now, which is interesting. Every single unit has a fireplace and every single unit has a washer and dryer, which makes sense because they used to be condos. This is a site map of the property. You can see the green lines indicating the driveway. It's a horseshoe with Augusta Court, Augusta Drive on your left-hand side, and San Felipe is in the north. So it's almost at the corner of San Felipe and Augusta Court, if you know the area. With respect to the apartments, these are the actual apartment buildings. With respect to the gym, which we will be converting into a future leasing office, it is located right here. The pool is located right here. We are installing a grill station, and that is currently a garden. We're filling that in and putting a grill there. And we are converting the leasing office back to its original design of being a unit. We did not underwrite this, by the way, as additional income. So this is just another conservative measure that we took, and you'll see we took a lot of conservative measures. With respect to the unit mix here, typically when we look at properties, we look for a diverse unit mix. We'd like to see a balance between 1 bedrooms and 2 bedrooms. But if you remember, in this immediate area, 63.1% of people live alone. So there is a high demand for 1 bedroom units. And you can see here, our property fulfills that demand. With respect to our floor plans, we have one of the largest floor plans across all of our different models in the market space. And that's because everything in the market space is A-class. And A-class tends to be smaller units because the cost to build, cost of construction is so high that you cannot build what you used to build in the 80s. Our 1 bedroom, 1 bath is 825 square feet. You see most downtown 2 bedrooms at that square footage. If you look at our 1 bedroom, 2 baths and a den, you can see it at 985 square feet. And then our 2 bedrooms, 2.5 baths jumps up to 1,350 square feet, which is several hundred square feet more than the average 2 bedroom, 2 bath in the market. With respect to average market rents, you can see here that we are coming in, and I just have to grab my notes here on the 1 bedrooms, average rent. So our average rents on the 1 bedrooms comes in at $1,236. The current is $1,597, and pre-COVID for the neighborhood was $1,648. If you want to look at 2 bedrooms, Augusta Court comes in at $1,417. The current is $2,149, and the pre-COVID was $2,396. This is just to show the differential between the current neighborhood and also pre-COVID rents as well. When we look at comps on the 1 bedroom side specifically, so here we're drilling down a little bit further to look at specific comps. Augusta Court currently on the 1 bedroom is priced in at $1,150. The Phoenician Apartments is a comp to the Augusta Court, but its newer construction comes in at $1,342. Augusta Court post CapEx, so post value add, we project at $1,360, and then Tate at Tanglewood is at $1,448. And the market average is at $1,597 for a 1 bedroom. With respect to a 1 bedroom plus a den, Augusta Court comes in at $1,280. Phoenician comes in at $1,352. Augusta Court post CapEx, we project at $1,650. Tate at Tanglewood, another comp, comes in at $1,940, and the current market rent comes in at $1,597. The numbers I'm giving you are 5 years out. So this is inclusive of forced appreciation and natural inflation. When you're looking at the comps and you're looking at market rent, you're looking at today. So you're not looking at any natural inflation. And remember, there has been historic natural inflation in this market at 3.4% year over year for the past 5 years. When we go to the 2-bedroom, we can't look at it the same way because the square footage is greatly different on the 2-bedroom and the 1-bedroom. There is a differential on the 1-bedroom, but on the 2-bedroom, it's vastly different, so it makes it harder to compare. When we look at price per square foot on Augusta Court, we're at $1.12 a square foot. The Phoenician apartment is $1.54. Augusta Court post CapEx, so post value add, is we project at 1.38. Tate at Tanglewood is $1.41, and Market is $1.97. Also worth noting, our 2-bedrooms are on average 300 square feet larger than these 2 comp properties. In addition, we have 2 bedrooms and 2.5 baths, and all of the comps only have 2 bedrooms and 2 baths. I have another video I'd like to share with you regarding the property. So moving forward to our business plan, these next few notes are going to cover the rent increases and vacancies. So in year 1, we are projecting 0 rent bumps. We are not going to deploy our value add strategy until year 2. Reason being is to be conservative, especially given our current situation. In terms of vacancy, concessions, bad debt, loss to lease, we actually increased the current situation. So their current economic occupancy is 87%. We have increased that to a year 1 average of 84%. In year 2, we deploy our value add strategy. We initiate a $97 rent bump, and we decrease vacancy, concessions, bad debt, and loss to lease to only 14%, which it is what we have closer to today. In year 3, we see a $165 rent bump because we're continuing our value add strategy, and we decrease vacancy, concessions, bad debt, loss to lease to 10%. In year 4, we do a $165 rent bump, 8% vacancy, concessions, bad debt, and loss to lease. And in year 5, the property is stabilized. This is now speaking more to natural inflation, which we have a $52 rent bump, 8% vacancy, bad debt, concessions, and loss to lease. In terms of our value add strategy, we are taking a 3-prong approach. First, starting with the interior and exterior. The interior upgrades include hardwood plank flooring, new kitchen cabinet faces, countertops, lights, plumbing, fixtures, paint, converting existing leasing office to a new unit. And the exterior upgrades include signage, landscaping, and paint throughout. With respect to amenities, we plan to, once again, paint the entire exterior, upgrade the pool, convert the gym to a leasing office and business center, upgrade the sun deck, and add a grilling station. And with respect to management, our management team has a strong track record of deploying creative strategies to attract new tenant bases. We are going to deploy those strategies, inclusive but not limited to social media, partnering with local businesses, communities, and organizations. And we're also going to increase our revenue and decrease expenses through our operational processes that we have already created, and we're going to deploy on this property to eliminate wasted spending. With respect to sources and uses, our sources here, the breakdown is the senior loan is coming in at 14.121 800. Investor sponsor equity is 8.3 and change, which totals to 22,427,887. In terms of the uses, as I mentioned, purchase price is 19.6, closing costs is projected at 585,887, capex and reserves at 1.85. Sponsor acquisition is 392,000, totaling the same as what I noted in the sources. Looking at our operating forecast here, we're going to highlight a few things. First, I want to talk about what I mentioned, that we added no natural inflation. So if you look at the first row, the annual rent escalator, you can see that in year one, we did 0% for an annual rent escalator. In years 2 and years 3, we did a 2%. In years 4 and years 5, we did a 3%. If you remember from the slide on the neighborhood, I mentioned the average rent increase in that area has been, for the past 5 years, blended average has been 3.4%. We don't even match what the historic average annual rent inflation is, and we don't even come close to it until years 4 and years 5. With respect to the average monthly rent, you can see that we are saying that the property will operate as it is today. We have no change in the average monthly rent. So we are at $13.11. And once again, vacancy and concessions, loss to lease, and bad debt totals 16% in year one, which is meaning that the property will perform worse under our management and through averaging out for the first full year of ownership. Going on to the investment structure, we have set up a waterfall structure. The first 8%, so 8% pref, goes 100% to the limited partner. The first hurdle, the 8 to 12%, goes to a 70-30 split. The next hurdle is 12 to 14% with a 60-40 split, and then 14% and greater is a 50-50 split. In terms of projected returns here, you can see that our average annual return is an 18.26, our internal rate of return is a 16, and our multiplier is a 1.91 with our average cash on cash at a 9.34. With respect to projected returns, if you were to invest $200,000, you're going to see that the cash on cash is a 5.84, member cash flow is 11,676 in year one, and then we can see it bump up. One of the questions that I get asked often is, why is there such a huge bump in the cash on cash returns in year 3? That is because we are deploying the value add strategy in years 2 and years 3, so you will see that jump significantly in year 3. The reason why it goes down in year 4 is because of our loan. So I will get to that in a second, but our first 3 years are interest only. So when the interest only period ends, you'll see a little bit of a decline on the cash on cash returns. But in terms of the total return on your investment, you're projected to get 182,560 plus your 200,000, obviously, back of your original contribution. So in terms of the cash flow over the 5 years, it's projected at 93,394, and projected proceeds from sale is 89,166. So that's how we get the 1.91 multiplier, 18.26 average annual return, the 16 IRR, and the 9.34% average cash on cash for our projections. As I alluded to earlier, the financing terms, this is a Freddie Mac loan. The initial loan is 14.12. Our current loan to value, we have quoted to us is 72.04. That's what we've underwritten, but we are pretty confident it'll land at 75. The rates is 3.07. The term is a 10-year term, 3 years IO, and over a 30-year AM schedule. With respect to sensitivity analysis, we have underwritten this deal very conservatively, and I know that is something that everyone says, but I think that you can tell just from several points that I've highlighted, and then I have another slide to even drill it down further, all the things that we've done. But we have taken several measures in which we have done a very conservative estimate impacting our NOI. With respect to how the cap rate is conservative, we assumed a 6 base cap rate at exit. The reason why we picked a 6 cap rate based at exit is it's a little bit tricky, but I'll explain it. So first and foremost, the the actual market in which we are purchasing the property and the class property trades between a 4.75 and a 5. That is the standard cap rate. Houston in general trades between a 5 and a 5.25. That's the average across all of Houston for this class property. The standard way in which people underwrite, its industry standard, is to add 100 basis points per year of hold. This is a 5-year hold. So taking the most conservative approach and using Houston, not even the specific market we're in, but using Houston at a 5.25, so that's the most conservative, and adding 500 basis points, you would have an exit at 5.75. So that would have been very conservative. But we used 6 because we were purchasing it at a 6, and we knew that no one would invest if they knew that our purchase cap was higher than our exit cap. So we've matched our purchase and exit cap. But we originally had this property under agreement prior to COVID. And when we originally underwrote this property, we underwrote it at an exit of 5.75 to be very conservative. Since then, because we were able to get the 11% discount, which equates to a 6 cap, we have rewritten the entire property, as you can see, changing our value add, changing our business plan, changing rent-ins in escalations, vacancies, concessions, loss to lease, to create more safeguards. And in turn, that has landed us at the 16 IRR projections. So you can see here, if we were to even use a 5.75 and our conservative measures on NOI were spot on, we would land at almost a 17 IRR. If we were able to increase our NOI, let's just say by 2% at the 5.75, you can see that it jumps to 17.82. If we use the conservative measure within our market, which the class property in our market trades between a 4.75 and a 5, and used the 5.5 as the exit, you can see that it jumps to almost 18% IRR, even if we hit our NOI spot on. So this is just a way in which you can look at both your NOI, your cap rate, and to determine your internal rate of return. With respect to COVID, I just mentioned that we took many different measures in which we wanted to be conservative in our underwriting. So first and foremost, we have a 11% discount on our purchase price. In year 1, we did no rent increases. We also, in year 1, increased our concessions, loss to lease, bad debt to 16%, which is steeper than what it is today. In year 2, we deploy the value add strategy. So we didn't even deploy it halfway through year 1. Our business plan currently states that we will not deploy it until year 2. If the opportunity exists to deploy it sooner than that, obviously we will. And obviously the return projections will shift, but our initial underwriting and what we are offering today is under that model. We've projected the 6% exit cap, which I just went over, and then also we inflated our insurance. This property is not located in a flood zone, but we are opting for flood insurance anyway. Our flood insurance plus our regular property insurance on the property we received a quote that came in $100 per door less than we have underwritten. All of the numbers that we have received that have come in less, we have not changed our model at all. We have kept them the same as we initially underwrote. In terms of safeguarding the property, this property can operate at 69% economic occupancy and still cover all expenses, including debt service. With respect to knowledge, I previously worked in clinical research and development for GlaxoSmithKline. And GlaxoSmithKline, if you remember, during the last pandemic, the H1N1 pandemic, was one of 2 companies in the entire country that manufactured a vaccine for H1N1. I worked in clinical research and development during that pandemic and worked in part with that pandemic to come up with a vaccine. So I am very familiar with not only what is going on today, the FDA process, World Health Organization. I worked directly with those organizations for years. So we use that knowledge to help forecast when we believe that we could execute certain strategies, for example, our value add strategy. And then we took an even more conservative approach just to add a layer of protection. With respect to timeline, so we had went under agreement July 3rd. In terms of our partnering financing commitment, we would like people to express interest by August 1st. We would like, end of due diligence is August 2nd. In terms of funding, we would like all funding to be in by August 16th, and we are closing on September 16th. Last but not least, I think that you probably have seen this around social media everywhere, which is be fearful when others are greedy, be greedy when others are fearful, by Warren Buffett. But I just want to say one thing. We personally have been preparing for this. Anyone that you invest in, whether you invest with us or you invest with someone else, they should have underwritten some sort of safeguards for a recession. We all know we were overdue for a recession. We look at this as an opportunity because we now know when that recession started, and we know that we are in the midst of a recession right now, and we can plan accordingly. So we are very excited about this opportunity because this is something that we have honestly been planning for in all of our underwriting, and now we know where to model it within our underwriting. So in terms of next steps, you can hold a place to invest alongside of us here at bardowninvestments.com Invest Houston. This is a 506c offering, meaning that it is open to accredited investors. You can invest the traditional cash way, or you can invest with your IRA. The minimum investment on this offering is $100,000. So once again, it's bardowninvestments.com /Invest Houston. And this is just, one last picture to leave you with of the Houston skyline before I provide you my personal cell phone number and email contact information. Thank you very much for the opportunity tonight. Thank you so much for your time. And I'm open for any questions you may have.
Well, thank you.
So hopefully I still made it on the hour.
You did. You actually did. You did great.
Even
Actually,
with the tech issue.
Yeah, you got 4 minutes prior. So real, Kaylee, got any questions, Kaylee?
Yeah, I've got a couple questions. One of the things that was a concern for us when we were purchasing, not the flats that's in Phoenix, our property that's in North Houston, kind of in the Greens Point area, was the new deliveries that are coming to market. What is the percentage or the amount of new deliveries that are coming to this specific market where you're at? Because that's, in Houston, you're right, is definitely a lot of construction.
So in this market, all of the buildings in the immediate area have already been torn down and rebuilt in terms of the Class A product. So we have differentiated ourselves between the Class A product and our product between $300 to $400 on average. So we don't believe that we are going to be competing with that Class A product because of the fact that we have created such a buffer between the two. And furthermore, we are the only large apartment building in the 1980s construction in this entire market. So in terms of the immediate area, there is no new construction that is a competitor to our current product. In Houston as a whole, obviously, there is new construction. You and I both know that. I already have another property in the Houston market, so I'm always concerned with that. But with respect to this product, we don't foresee that being a competitor, because it's just a different tenant that would come to a property like ours versus a property on Class A construction. I mean, you're talking about like on the low end, $300 to $400 and upwards to over $1,000 in terms of the rent differential.
Got it. Couple more. What's the minimum investment?
$100,000.
Okay. And whenever the HEROES Act, if it does get passed the next week or two, and we're not able as operators to evict people at all for 12 months for no payment of rent, what is the plan there? Because it was before where like I have some properties that didn't have agency, so we could still evict people. That was great. But then now it's just across the board, all USA, all renters.
So we actually work very closely across all of my properties with helping tenants not only be able to pay their rent, but in terms of helping them get on their feet with applying for unemployment. We literally walk them through how to apply for unemployment because the sooner they apply for unemployment, the sooner they'll pay their rents. On just as a comparison, on another property I run, we have 98% of collections versus billed. So on average, since COVID started, that's been our rate. So we work very closely with them. In terms of this current property, there is no one that is currently scheduled for evictions due to delinquency. We will continue to monitor that because obviously what we would like to do is set up some sort of payment arrangement, payment plan, because when you can't evict someone, you are really left with no other option but to hopefully collect as much as you can. We also deploy the Rhino program. I'm not sure if you guys are familiar with that program or not, but that's a program that helps safeguard us in terms of when a tenant needs to be evicted or if a tenant skips, that we can collect back what it was owed. So that's another program that has been proven to be hugely successful across all of my properties.
Is there any, I guess, so plan for like a rent strike?
So we have talked about that. There are areas in Houston where they have spoken about that. This particular property in this area, they haven't spoken about that. We would have to continue to monitor the situation. We literally, our property management team lives in Houston, so they're very, very well versed. They sit on the NAA and TAA. They're also trainers on the TAA. They also go to Washington and lobby for landlords. They are very, very well connected. In fact, one of their family members, immediate family members, is the largest student housing developer in the entire country. So, and he also builds residential as well. So they just have a lot of connections in terms of us seeing things before they come to existence. For example, when codes are changing in the Houston market, we know that typically almost a year before a code is issued. So when we look at properties, we can underwrite it in our CapEx strategy if we know that we have to change something out.
That's awesome. That's awesome. The only creative strategy I've heard of that, you know, might work for this class, maybe not, because it does for A class, is those people might be able to pay, you know, 12 months ahead and they get 15 months or something like that, or a cheaper rate if they pay all at once or something like that. So otherwise, that's cool.
We do deploy measures like that too. So we do a couple different things. My opinion is always to look at things from not only from a business standpoint, but investment standpoint. And the sooner you get cash, the better. So we do incentives to have people pay early because in this class property, it might not be as much of a concern, but when you're looking at C and B minus class property, people typically in that class property spend what they make. So to get that money sooner than later in terms of incentivizing people to pay their rent early has worked out extremely favorable on other properties that I manage. So we take on that tactic as well as providing incentives for lease renewals because obviously spending less operational CapEx or just operational turns and R&M, we limit that exposure when we're increasing the exposure on, you know, getting people through the front door, keeping people at the property.
Awesome. And only one more question. If someone came to the group with a 1031 exchange, would you be able to tick at this point?
It depends on the size of the tick. We have been offered quite sizable ticks, but if they aren't significant, then unfortunately, no, we are not taking ticks.
What are you saying significant, like $1 million, 2 million, something like that?
Several million, yes. Yeah. We, just to put in perspective, we've already turned down a couple millions.
Yeah.
So a couple 1 million.
Yeah.
I said it, just to be clear.
Yeah. All right. That's all I got.
Gotcha. Antoine, got any questions?
Sure. Thanks, Ashley, for your concise and professional presentation. Right, I know it's a very short period to pack it all in. Appreciate it. One of the questions I have when I look at your presentations, maybe it's an error or maybe it's really the case, but I think it shows the comps where the Taylor Tanglewood, which I think is a relatively new property, like kind of 2014 or 15 build. In the comps, it shows that the 1-bedroom and then has higher rents than the 2-bedroom. So is that accurate? And if so, what is the reason why the 1-bedroom and then is actually renting significantly higher at the Tanglewood? Because you essentially assume, based on that presentation, that the 2-bedroom Augusta Court would be able to rent for more than Tanglewood, right? The Tanglewood. Now, I understand, obviously, there are larger units, which is an argument for it, but Tanglewood still is still a Class A property, right? Whereas you are a B class that gets into an A, maybe A minus. So just if you can maybe touch on that. And the other question I have is also related to the comps. What are the other properties in that submarket that push the market rents much higher than even where the Tanglewood is at? Because I think that's pretty close to the top end of the in that submarket. So I'm curious where they are.
So to answer your first question, it's a little bit more complicated than to be able to like condense in one slide, but I'll definitely explain it here. Tate at Tanglewood, I'll just speak to the properties that I selected as comps. In terms of a true comp, there is no true comp in the market. This is the only 1980s vintage property. Everything is newer construction in this specific market. So when you look at the two properties I selected, so the one property is the Phoenician Apartments. The Phoenician Apartments are an older constructed property, but haven't been renovated since they were constructed. I believe it was in 2007. I have to double check that, but I'm pretty sure it was early 2000s that it was constructed. So in terms of picking it as a comp, it was the closest in which I felt that it was dated, but yet still could measure up against our property. It was the only one I could find dated. The reason why I picked Tate at Tanglewood is because across the street from Augusta Court, not facing Augusta Court, but on the other side of the street, the same block, is Tate at Tanglewood. It is the closest property to Augusta Court, and that's why I selected it. In terms of why the rents look inflated and the 1-bedroom and the den looks more inflated than the 2-bedroom is because of the unit size. So the 2-bedroom on the Tate at Tanglewood does not have a comparable unit size on 2 bedrooms. Furthermore, it's 2 bedrooms, 2 baths, where we have the 2-bedroom, 2.5 baths. So it is, in all honesty, in my opinion, it's not a true comp, but it is the closest thing I have to a comp to present. So that is why I selected it. But unfortunately, the 1-bedroom, 1 bath comps out better in terms of square foot and comparing apples to apples. But if they had a 2-bedroom, 2 bath, they're at a pretty high price per square foot that it is, I can't remember the exact number off the top of my head. I can pull the presentation to get the exact figure to give you specifics, but we're talking several $100s more. So it would be, it just depends on how you analyze the data. And ultimately, if you look at $1.41 per square foot, which is what Tate at Tanglewood has, our our square footage on our property to be able to comp it is over, if you multiplied it by our square footage, it would be over 2,000 a door, and we're going, I believe ours is 1875. So I think they ended up at around 2,100, if I remember correctly. I mean, I can get the numbers for you offline. I just don't have them in front of me right now. But that is why it is very difficult to show the 2 bedrooms. And in all honesty, I've changed this slide multiple ways to try to be able to show it concisely, because the 1 bedrooms are easier to comp out and show in a graph. And just unfortunately, the 2 bedrooms in comparison don't. So.
Okay. Appreciate that.
Absolutely.
One other question I have is looking at your pro forma. First of all, it's great to see that you are conservative on the expense side, right? You're not squeezing
Thank you.
everything out of there. We have seen plenty of pro formas with unrealistic expense assumptions, so that's very good. One of the question and kind of a concern I have is it's obviously good that you are not assuming any rent bumps over in year 1, but one of the concerns on my end, and maybe you can explain that a little bit more, how much of the I think roughly $12,000 that you have in reserves and capex budget, how much of that actually is capex? But in that regard, obviously, whenever you do essentially, and I assume that you are planning to rehab a majority of the units, it's always tough to do the rehab and still keep the vacancy down at the reasonable level, as well as because you have a tenant turnover and all that to keep the economic vacancy at the reasonable level. So there, my concern would be a little bit when I look at that number. I know you bumped it up, I think, from 13 or 14% economic vacancy to 16%. But my question is, how comfortable are you with that 16%, considering that you have not just tenants that you have to replace, you also have to rehab, you have the time to rehab, the time to re-tenant, and that you have to add on top of the usual vacancy that you have to work with.
Absolutely. So with respect to these units, just to start there, they used to be condos, so they're renovated at all different levels because they were individually owned, and when they were all taken over, they were all at different points of finishes. And when the current ownership took over the property, they have renovated things at different levels. So for example, a lot of the units already have new cabinets, shaker cabinets, already have granite countertops. They have, some units have the vinyl plank flooring installed in them already. Some of them have updated hardware package. So in terms of a typical renovation that we would do on a property like this, if we were starting with what you would assume you would inherit from a 1980s property, it would take max 2 weeks. We could probably get it down to about 6 days if we have, you know, all the materials ready, everyone lined up, and no hiccups along the way. So with respect to the fact that these units are in all different levels, we believe that we can come in and be closer to the latter end of what I just mentioned to you, closer to 1 week, and we'll try to shorten the timeline as much as possible due to the fact that there's a lot of finishes that are already in place on the property. So it's just a matter of harmonizing the units, because it's obviously, I think one of the challenge in renting a unit is not being able to see the actual unit that you're getting and the finishes and the package that it includes. So we want to create kind of a package that some sort of harmony between the units. So that's the one thing. The second thing, to your point on There will obviously be some vacancy while the renovation is going on. I 100% agree with you. However, this property has a historic occupancy of 98% plus over the past 10 years. I think in terms of what I'm seeing right now on the 92%, I know for a fact because I've seen, I get the financials every month and I see where the current ownership is cutting. They're literally cutting their maintenance. They've cut marketing to nothing. They're not spending anything on marketing. So in terms of our ability to keep the property occupied and renovate, in all honesty, if there was a concern, it should, in my opinion, based on the fact that people have lived at the property for 2 years greater, they can afford the rent bumps. The question we are going to have to weigh is, when we get a unit that is coming up for renewal, how much do we push the rent to see if we can capture the current tenant versus force the tenant out and take it back and renovate the property? Because ultimately those tenants can afford to stay. Every other tenant on average can afford to stay, and they can pay even more than what we're projecting to push the rents to with natural and forced inflation over 5 years. I mean, that's an anomaly. So in terms of being able to balance it, I'm a very hands-on owner and operator. I think you can probably tell that by the level of detail in terms of this presentation and the ability of how I manage. And if you speak to any of my investors or other partners, they will tell you the same, that I'm very detail oriented. So I literally check our property multiple times a day, a little bit OCD about it. So one thing that I am always on the pulse on is not only does what do I think our current tenant base can handle, but what is the market currently doing? So for example, on another property I have, we are literally managing to see what unit should we be renovating first? Should we be renovating 1 bedrooms or should we be renovating 2 bedrooms? And we literally look on a weekly basis to see what is the best ROI. I also too, if we're not renovating 100% of the units, I've figured out a formula in which is not that difficult to do, but a formula in which it tells you whether or not you should renovate the unit as a full renovation, a partial renovation, or not renovate it at all and go to the next unit based off of the cap rate. So I plug in all these formulas to tell me which units I should be renovating, because we walk every unit and get a spec sheet on the renovation and we plug that in. So every unit is hand selected in terms of renovation. On this particular property, we have the ability to renovate all the units. With respect to your one question on the breakdown of the CapEx, it comes in at 1.75. We have 1.85 on CapEx and reserves. Because we are raising all the capital up front, this is not a bridge situation where, you know, your renovation cost is going to be looped in on the loan. We have Freddie holds back 500 of our raise on CapEx and reserves for the reserves. So we have some money to play with, but ultimately we're not deploying that money until year 2 based on this underwriting. I mean, we could deploy it sooner. So there's a lot of opportunity when you look at, we could deploy the strategy sooner in year 2, right? And we have a lower vacancy, concessions, loss to lease, bad debt in year 1 anyway, if we were to deploy it earlier and then recapture in year 2. We have that option.
Okay, very good. Appreciate it. Thank you.
Thank you so much.
We have a question here from Karen. Karen. Go ahead, Karen, you there?
I'm here, but my question was answered. I was just concerned about the rent raises and such a big jump in the next 2 years.
Okay, that's good. I have a question. Do you know any of the impact of the retail decline of the Galleria Mall?
So we haven't seen any statistics and modeling on the retail impact. The mall, I was just at the property less than 2 weeks ago, and the mall was open. I mean, I'm not sure if anyone on the call is from Houston, but Houston is acting as if like everything's good. All the restaurants were busy. We went out to eat every night we were there. So there is definitely impact on retail in general across the country. I think that when you look at the overall economics, retail is definitely a contributor overall to the Houston market, as I presented on the one slide, but we don't have recent data on the impact specifically to that mall.
Gotcha. Okay, gotcha. Could you put just the slide up of your information again? The slide of your contact information?
Yes.
Anyone got any more questions?
When do we make the offers?
Sorry, this is, here you go.
I think we decided to contact her if you want to do the offer, right?
$506C.
A good deal. All right. Anything else, anybody? Before I wrap it up?
Get in touch with me after this. I've got a Japanese group I want to introduce you to, and 2 different funds who have been bugging me, and I don't have anything. So actually, the 1031s that I have, the tick net, they're going to be too small for you. So that's all I do have to offer. If that helps.
That definitely helps. I will be in touch.
And then bigger groups. Yeah. Okay. Cool.
Thank you so much. Really appreciate it.
Anytime you got any advice for?
No, it's obviously you're willing to step out into the market in the current environment, which is takes a little bit of guts, right? But it's good that you're doing it. Sub-market is certainly strong, and I think that will be to your advantage with this deal. As Kelly mentioned, she has a couple of groups. I think for larger equity checks, that potentially is a little bit of a easier sell to them, because they look at the dirt and the overall value of that submarket probably a little bit more than the typical passive investor in syndications.
Yeah, and the only reason I offer them is because they're willing to do LP.
Good deal.
Awesome.
Great. Anything else? All right. Well, thank you. I'll wrap it up with that. Y'all have her contact information. Feel free to contact Ashley when you're ready, okay?
Thank you so much again. I really appreciate it.
No worries. Thank you for your time. Thank you.
Thank you, Rockstar. See y'all later.
Have a great night.